Thank you, Kevin, and thanks to all of you in the audience for attending the 30th Annual Meredith and Grew Seminar. Despite the many events of last year, subprime, CDOs, Lehman, the bailout, yada, 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 today I want to share my thoughts on what I'm seeing, or at least point out where there may be some opportunities. With all the changes we face in this market, we need patience, creativity, and a reversion to standards of an earlier time. For those of you who were here last year, you heard me say, '07 felt like heaven. And not to hesitate in '08. This year's a little tougher. I would propose that we try to find the shine in '09. But first, let's start with some facts we've all probably heard more than we care to. CMBS is dead. Large banks and investment houses are either failed or wounded so badly that confidence fails them. No one knows when it will return or to what extent. Experience tells us, though some will exit the industry, some will reemerge at capacity to work with us again. Many have gone on to raise funds for note acquisitions, new debt vehicles, or equity capitalization. My suggestion is stay close to these folks. Today, fund managers are looking to be as liquid as possible because of risk of redemptions. As a result, they are investing more money in liquid assets such as corporate bonds and, more importantly, treasuries. With this flight to safety, 10-year treasuries are now in the 2.6% range, the lowest I've seen in my career. All this, coupled with lack of lending competition and market fear, is limiting liquidity available for real estate investments. Spreads now are a thing of the past as real estate lending is yield-driven. For real estate as an asset class to compete for allocations, commercial real estate spreads had to go up. In the past, 75% leverage mortgage pricing paralleled BBB corporate bonds. Today, with loan-to-values coming down in the 50 to 60% range, pricing is closer to single-A corporate bonds. As a result, today 10-year interest rates are in the high 6s to low 8% range. Life insurance companies. Life insurance companies and pension funds allocations, when allocations are made, are far from filling the void left from the CMBS exit. Still, life companies remain a relationship business between lender, correspondent, and borrower. My suggestion, get friendly with your mortgage correspondent. Wait a minute, that's us. Stay close. Though limping, life companies stand to greatly benefit from the CMBS debacle as borrowers refocus on certainty, service, and flexibility. After taking off the last quarter of 2008, many life companies are once again looking at deals and will provide leverage in the 50 to 65% range for terms of 5 to 25 years on a non-recourse basis. Commercial banks. Commercial banks consist of those too big to fail, those small but nimble and prudent, and those flirting with precipice. In fact, coming out of the last market cycle through a period of consolidations, a number of very talented and well-trained lenders dispersed to small local and regional banks. These old friends have done well with their commercial real estate investments and, in fact, have been eating everyone else's lunch for the past 12 months, writing what I think are pretty solid loans at good spreads over their own cost of capital. They are the permanent lenders of choice today and for mid-market, high-quality, well-sponsored assets. Against this economic backdrop, let's focus on where opportunities lie that will inspire investors to say, I want to make it mine in 2009. So where's the action? Note purchases. Many holders of notes, such as banks and life insurance companies, want to or need to raise capital. If a bid-ask gap remains between buyers and sellers of fee-simple interest in real estate, the door is wide open for investors to pursue discounted note purchases. Notes secured by land and non-performing assets and junior note positions have traded well below their face value, approximately at 50% and less. Notes written for securitization have more typically sold in the 60 to 85% range. On the other hand, we're in the process of closing a portfolio loan sale of high-quality life insurance company loans for 97 cents on the dollar. But let's be clear, this was driven by the yield, but most importantly by the quality of the asset. Note acquisition finance. This is a new business line for lenders. There are a variety of new lending programs available for financing the acquisition of debt. In the case of better quality and longer-term debt acquired by a third party, the likely sources are banks, a debt fund, or a life insurance company. Generally, the availability of this type of financing is up to 70% of the underlying collateral value for longer term and will be priced in the 7 to 9% range. For lenders out there looking for liquidity, here's one to think about: hypothecation of mortgage. Much like investors borrow against the value of their security, or at least used to, a lender may pledge its mortgage as asset as collateral for a loan. We expect that behind the scenes, more lenders will become borrowers by pursuing this strategy and need a variety of different lending sources. That's where we come in. Depending upon the loan amount and terms requirements, the borrower, in this case the lender, may find capital sources in bank, debt funds, and life insurance companies. Gap equity. It's no secret. Loans originated over the last year were aggressively underwritten. These same loans would near maturity face a difficult challenge. At maturity, with lack of lender competition and with new underwriting guidelines, these loans will most likely suffer a shortfall of first mortgage proceeds. Currently, mezzanine lenders, equity sources, and new funds are raising capital to bridge the gap between the new loan amount and the required payoff amount. Though this may be financially painful, gap financing provides an opportunity for lenders and borrowers alike to solve an otherwise more serious problem. The last thought I'd like to leave you with is probably the most important. We're in a relationship business. Though default and delinquencies remain low, in the face of declining fundamentals, portfolio lenders and existing borrowers have the ability to expedite mutually beneficial opportunities by working together. This may include loan modifications for existing borrowers, such as amortization, allowing for interest only, waiver of prepayment penalty, or granting a borrower the ability to realize a windfall when buying back their own debt at a discount. But by doing so, banks and life insurance companies can avoid taking back assets, can raise capital, reduce exposure, and strengthen their own balance sheets. Good luck accomplishing the same with a special servicer. In our capital markets view, those are the opportunities presented to us and to the universe of borrowers, lenders, and equity providers in 2009. Now I'd like to introduce my partner, Ron Perry, to talk about the downtown. Thank you.